How does the infinite banking concept work for real estate investors? First, start with a top-rated mutual insurance company. A mutual insurance company pays dividends back to their policyholders. They invest more conservatively, and you know you're going to make money every year. Second, always use whole life insurance. Whole life insurance is fully guaranteed. You never have to worry about increasing insurance costs, and it's time-tested. It's been around for nearly 200 years. Third, a properly structured high cash value policy designed for infinite banking and real estate purchases. This is key. It's one thing to have the right company, it's one thing to have the right type of policy, but it's another thing to have that policy designed correctly, specifically to grow maximum cash value. When you have a whole life policy that you want to use for infinite banking and real estate purchases, you want a policy that gives you the maximum cash value growth and the minimum insurance cost. Here's an example of a properly structured whole life policy specifically designed for infinite banking. This illustration is designed for a 43-year-old real estate investor. He's putting $50,000 a year premium into the policy and a lump sum of $150,000. We see then the total contract premium year one is $200,000. When the $200,000 goes in, we're looking at net cash value in this column here. There's $188,000 of the $200,000 that goes straight to cash value. I'm often asked, what is the difference between the non-guaranteed values and the guaranteed values? The guaranteed values do not include the dividend, whereas the non-guaranteed values do include the dividend. Dividends have been paid by the mutual insurance companies that I use for 120, 150, 175 plus years. We don't know what the dividend will be from year to year. That's why it's not guaranteed. But these companies have always paid a dividend. And you see that dividend column here. The cash value continues to grow. And you'll notice it's growing by more than the $50,000 that's going in. As a matter of fact, this policy almost breaks even in year three. $298,390 of cash value. At that point, there would have been $300,000 of premium that went in. So from that point forward, there's more cash value than premium that has been contributed. Sometimes whole life insurance gets a bad rap, and it's because most insurance agents out there are not designing policies correctly. They're putting most of the premium, if not all of the premium, into base, which is purchasing large amounts of life insurance with zero to very little cash value. This policy has what's called a PUA rider. PUA stands for paid up additions, and PUA is a must. It's what turbocharges your cash value. The majority of this $200,000 is going into PUA. That's why you see the $188,465 in first year cash value. These are low commission products because most of your premium goes to cash, as opposed to the old style traditional whole life where most of the premium goes to purchase life insurance. Those are very high commission products, and that's why whole life gets a bad rap. But we're not doing this for the life insurance. We're doing this because these policies, when structured correctly, give you much more cash value, guaranteed growth of your money, access to liquid cash, and tax-free use of that money. Let's now look at policy loans for real estate and how you can use a high cash value whole life policy to create more wealth. In year 4, the cash value is $357,000. He's found a great real estate property and he wants to take a policy loan for $250,000. He's going to be his own bank. You can take policy loans as soon as 30 days after you've made the premium payment. So that $188,000 that you see there in the first year, you can borrow 90 to 95% of that 30 days after you make the premium payment. It's very simple to get a policy loan. When you make the loan request, the insurance company usually has that money deposited in your bank account within 3 to 7 business days, sometimes sooner. Remember, in that year, the cash value was $357,000. He wants to take a loan for $250,000. And what's interesting about this is when he takes a loan, the insurance company doesn't physically remove that money from his cash value. He's still earning interest and dividends on the $357,000 total. So he never breaks the compound growth curve. He's still earning interest and dividends on the $357,000. If this money were invested elsewhere and he took out $250,000, he would break the compound growth curve and would have to start over again. But not in a high cash value whole life policy. Your money's still working for you. Imagine this straight line represents the dollar amount of zero. When he takes a policy loan, he gets to pay the loan back however he wants over any period of time. We call this principal reduction. Let's look at the math to see how this works. We're going to put in our $250,000. He can pay the loan back however he wants. Current loan rates are between 4.5% and 6%. We're going to use a 5% loan rate. And let's say he wants to amortize the $250,000 loan over the course of 20 years, which is 240 months. That would mean he would have a payment of $1,649. The 5% interest does go back to the insurance company. There's misleading information out there on the internet. The interest you pay on the loan goes to the insurance company. Every month that he pays back the $1,649, the balance of the loan is going down. This is the principal reduction that I was talking about, which means month after month, less interest is being charged. At the end of 20 years, he would have paid a total of $145,973 in interest. So let's make a note of that. Interest that goes back to the insurance company. But remember, the $250,000 wasn't physically removed from his $357,000 of cash value. We're going to look at a future value calculator. What did the $250,000 grow to that remained in his policy? We're going to look at it over the same 240 months. The policy is earning around a 5% net tax-free rate of return. So over that 20-year time frame, his $250,000 grew to $678,160. When we look at the difference between the $678,160 and the $250,000, that's a $428,160 difference. Let's make note of that. We know he paid $145,973 back to the insurance company, but he earned $428,160 on the $250,000 that stayed in his policy. When we calculate the difference between the $428,160 and the $145,973, he still came out a positive, this is a positive, $282,187. By using his policy as his own bank to buy real estate, he's making money in the real estate deal, and he's still earning interest and dividends on his policy's total cash value. As a real estate investor myself, I use policy loans for the down payments on my real estate deals. Some of my clients are taking policy loans to buy the real estate outright. However you do it is up to you. But by using a high cash value whole life policy specifically designed for the infinite banking concept, you're making money in two places. We call this the velocity of money. Your dollars are doing more than one thing at the same time. And not only that, but there are many other benefits of infinite banking and high cash value whole life. You get guaranteed growth of your money. You have access to liquid cash through policy loans for real estate, as I've shown you. Tax advantage growth, and tax-free use of money. This can become a stream of tax-free retirement income for you. There are flexible premium options. The policy we just looked at, you could continue to put in $200,000 year 2, 3, 4, 5, but you could also go down to the minimum premium of about $15,000 per year. The policy is not tied to the stock market. There are no losses. You make money every year. High contributions are allowed. There are no caps like a 401k or a Roth IRA. Each person's ability to contribute high amounts of premium would be based on age, health, income. We look at that together. Collateral assignments with banks. You can use your policy as a collateral assignment where you become a more advantageous borrower. Banks love permanent whole life insurance because they know that if you pass away and you have a loan with them, they don't have to foreclose on your property. There will be a death benefit that comes to them to pay off your loans. And as I mentioned, your total cash value grows despite policy loans. To reiterate, when you take a policy loan, the insurance company does not physically remove that money from your cash value. They put a lien against it. You're still earning interest and dividends on your total cash value, even though you have a loan. To learn more and to see your own infinite banking numbers, reach out. Would love to show you how a high cash value whole life policy specifically designed for infinite banking can benefit you and help you have more success as a real estate investor, making money in more than one place at the same time.